Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman, president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we're going to look at, take a closer look at fixed income investing, how to best prepare yourself for inflation and interest rate hikes, and how to allocate your credit capital in these volatile markets. Nice to see you, David.
Good to be here as always.
So historically, what have been the benefits of investing in fixed income?
Yeah, and the key there is historically, and there's four benefits, the characteristics of fixed income investing that accrue to fixed income investors, and I think we have a board for this. The first is capital preservation, so that when you're effectively lending money to credit-worthy borrowers, there's very little chance that if you wait until maturity that you're not going to get paid back. And so capital preservation is the key driver for a lot of investors. Check. And then you look at yield. And when you have fixed income, it's what it implies. It's fixed, it's consistent, and you can count on getting that coupon every quarter or every year, whatever the case may be. Then you look at low volatility. And traditionally, the volatility in the bond market is less than 25% of the volatility in the equity market, so that you get a smoother ride even during bumpy times. And finally, we look at diversification, and that really has two elements to it. The first is diversifying away from equities because of the inherent volatility that equities bring. And the second is that you're able to diversify among bonds, whether it's the type of bonds, the duration of the bonds, or the geography where they emanate from.
But David, as we speak today, what are the disadvantages to this traditional approach to fixed income investing?
Well, here's the problem, that we've just come to the end of a 20-year bull run in bonds, where essentially most people are familiar with the concept of the inverse relationship between bond prices and interest rates, so that as interest rates precipitously fall down towards zero, where they effectively are today, the value of the bonds that everyone owns goes up. But today what we're looking at, what I would call the double whammy of long-term fixed income investing. The first is that you're looking at negative real returns on those bonds. So when you take inflation into account, you're actually going to lose money by owning those bonds because the rates are so low. And the second is that as interest rates invariably go up, you're going to look at a reduction in the value, in the capital value of those bonds. And so that's the double value, the double whammy. And as we look around the world and we see sovereign debt in places like Europe, and we see the debt ceiling debate in the U.S., and we see, stimulative monetary policy among all the G7 nations, that points to the two enemies of fixed income, which is increasing interest rates and increasing inflation.
So hence the double whammy. How does an investor protect oneself against that?
Well, if you're a long-only bond investor, you really have two choices. You can shorten your duration, which means that you don't get the tail risk of having a long-duration bond. But, of course, that means that you're going to get paid virtually nothing to hold it. Or you can be truly defensive and go to cash. But that's like saying, I don't want to get hit by a bus, so therefore I'm not going to leave the house. You're not going to get hit by a bus, but you're also not going to achieve very much. So sort of the moral of that story is that as you look out into the medium and the long term in the fixed income environment, is don't be long bonds right now. And most, perhaps there are certain long bond advocates who would disagree, but most people would agree that that's generally the case in the environment with which we currently find ourselves.
All right, David, we'll pursue this story as we go along. Coming up on Alternative Investing, we'll bring on our expert to discuss the inner workings of credit and strategies for your own portfolio. That's after the break. Welcome back to Alternative Investing. I'm here, as always, with David Kaufman, the president of Westcourt Capital. This week, the topic is fixed income investing, including credit hedge funds. And joining us for a closer look is Mike MacBain. He's the founder and chief investment officer with East Coast Fund Management. Thanks for coming in.
Thank you for having me.
So you have quite a vast experience in credit markets. Give us a sense of where you've been and what you've done.
Well, we started East Coast Fund Management in May of 2009, and I started it with John Schumacher. John Schumacher is the ex-co-CEO of Scotia Capital Markets. In my previous role, I was the president of TD Securities. And in both of those roles, John and I were responsible for the global trading rooms at those two major banks. So we've been around a little bit. We've seen the fixed income markets through good and bad. And I think the differentiating factor in our experience that is really a function of having those senior roles in those jobs, it was our responsibility to make sure that the balance sheets of those firms were taken care of when things were going sideways. And so the key aspect of running a balance sheet as big as the bank's balance sheets in the 150 billion plus is that when the markets are challenging and markets are going down and up and volatility is very high, the key factor is finding a way to uncorrelate that portfolio. And so uncorrelating the portfolio could happen in many ways, but basically you've got to come up with a risk management methodology that makes sure that your core portfolio of long assets isn't actually losing money when the market's going down. And so it's a very similar strategy that we developed at the banks that we've dropped on top of our fund at East Coast Fund Management. A little bit less complicated because the balance sheets of the banks are obviously very big. The asset classes from equities, fixed income, foreign exchange, money market, and credit, and all the derivatives across those things, but still the same. I mean, that goes into a little bit into our experience as it relates to the markets and where we sit in today's market. We hate the equity market right now. We think that 20 years of volatility in the equity markets and no returns to speak of are something that we really want to avoid. We don't like that volatility at all. And earlier I heard you talking previously in the show that we are at a cyclical low in interest rates, and we've been in a secular decline in interest rates for the last 20 years, and interest rates at 2%, 3%. Doesn't give your portfolio the protection that you want to give it. And so today we're here to talk a little bit about how you can invest in a low volatility fixed income product that doesn't have that interest rate risk.
Now, you and your partner, John, have a deep history in the credit markets, and even though most Canadians certainly have been invested in bonds for a long time, that doesn't mean that we investors understand credit the way we should. So can you give us a quick sort of 101 on credit, and especially to understand the capital stack, where it falls in investing generally?
For sure. Well, first of all, let's talk about credit. Credit and debt are really used synonymously. So when you talk about a company's debt, you're really talking about the credit at the same time. So if you look at the capital structure of the debt capital structure of a typical company, I think we have a board on this to show everybody at home, but I think the capital structure, basically you can have senior debt, you can have sub-debt, you can have convertible debt or capital securities, and you can have equity. I mean, most convertible debt and capital securities are at the same level of the capital structure as is equity. And so that's pretty key to know when you're investing in bonds. The other thing that's key to know when you're investing in bonds, particularly fixed coupon debt, there's two different risk characteristics in fixed coupon debt. There's interest rate risk and there's credit risk. So if I give you an example of that, a 10-year Shaw bond today yields about 5.1%. 10-year Government of Canada bond yields about 2.85%. So the remaining 2.25%, that's the money that you get paid, or the premium or spread that you get paid, is known as the credit spread in the market, that you get paid to take the risk that Shaw Cable will pay you back. And so when you look at buying bonds and you look at credit, you need to look at those two risks separately, particularly in today's market, where, as you said, interest rates are so low, and do you really want that risk?
Now, Mike, there's all kinds of credit hedge funds, distressed, high yield, investment grade, long, short, event driven, and so on. Maybe you can explain the strategies and the objectives, especially as they pertain to Canadian funds and Canadian investors.
Right. Okay. Well, credit, there's a number of global credit funds, probably too many that we have for us to have time to talk about, but primarily in Canada you have investment grade credit funds, you have high yield credit funds, and there's a few distressed debt funds.
And just briefly describe investment grade. What does that mean, briefly?
So investment grade credit would be those companies that issue debt that are rated BBB and above. So BBB, single A, double A, triple A. So I don't want to get too complicated, but so that's an investment grade company. High yield companies are rated from low BBB down to CCC plus, and then distressed companies aren't rated at all. So that's the gambit of least risky, most liquid is investment grade, most risky, least liquid, and distressed debt. To further complicate things a little bit, that capital structures board that we had up a minute ago, each of these companies can have all of those different levels of debt. And so you can see there's lots of opportunities to pinpoint where you want your risk in the capital structure and across the spectrum of creditworthiness of companies. We've chosen to target our product and our fund in the least risky, highest liquid product, because our goal is to generate the highest risk-adjusted returns, and we think that's the way to do that.
Let's get into that in some detail about your core strategy, which focuses on investment grade in Canada. You just said yourself that it pays the least, but it's the most liquid. But you're not. That's not why you're targeting it or how you're using it. Can you explain how that strategy works?
Sure. We're targeting high risk-adjusted returns because we really believe that that's the only way to sustainably grow wealth over time. We want to earn 6%, 7%, 8%, 9%, 10%. And in a really bad year, we want to lose nothing or lose 5%. We think that's how you build wealth. We don't think you build wealth by earning 20%, 20%, 20%, 20%, and losing 50%. That destroys wealth because you're left with 90% if you do the quick math, David. Investment grade funds, we talked earlier, BBB to AAA bonds of corporate debt. There's a number of ways that you can invest in investment grade credit. You can buy bank loans, you can buy floating rate notes, or you can buy which we prefer to buy and we trade in as fixed coupon debt. We don't like bank loans because it's a pretty closed market, controlled mainly by the banks. It's hard to enter and hard to exit, and can be illiquid from time to time. So we don't really trade in that market. We don't like the FRN market for similar reasons, but more. First of all is they're not liquid at all. The second reason is that FRNs pay about 75 to 80% of what the same fixed coupon bond would pay for the exact same credit risk, so you get underpaid for it. And the third is that only about 20% of the country's issuing companies actually finance themselves using FRNs. So there's not that much availability of product, and it's very hard to get a diversified portfolio.
And one of the keys that we hear about with bond funds generally is the use of leverage. And of course, your prime broker is your best friend until they become your worst enemy when you get the margin call. Yeah. How much leverage are you willing to use, and how do you compare that to the other funds that are going to get the outsized returns if they have higher leverage?
Yeah, so I mean, leverage is a big question. You really need to think about leverage and volatility of your portfolio synonymously. So when we look at separating the risks of our portfolio by hedging out all the interest rate risk on the bonds that we buy from the credit risk that we want to take. And so you've changed the makeup of the risk in your portfolio by doing that. So like you said, you're left with credit risk. And so we do enhance the return of our credit portfolio using leverage. We use modest leverage, so on average we're leveraged 2 times. We have a cap on leverage of about 4 times. So that we think is relatively low, and I'll tell you how we came up with that 4 times leverage. If we look at historical price volatility or risk in a investment grade fixed income security, about 75% of that risk comes from the interest rate portion of that bond, and 25% of it comes from the credit risk. So we figured that if we're going to take 4 times leverage as a maximum in our fund, that it really shouldn't look too much different from the original security that we were trading in the first place. All we've really done is up-tiered our risk profile and made that risk a higher risk-adjusted return.
All right, Mike and David, we'll take a short break right here. Stay with us. We'll talk credit investment strategies with Mike MacBain right after this.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here as always with David Kaufman, the president of Westcourt Capital. This week we're discussing fixed income investing, including hedge credit funds. And joining us for a closer look, still with us, is Mike MacBain, the founder and chief investment officer with East Coast Fund Management. Now, Mike, before the break, you talked about how you like to invest in the credit part of the bond and hedge out the interest rate risk. How important is that when interest rates are expected to start rising?
Well, it's very important because you don't want your capital getting eroded by interest rates rising. David mentioned earlier, when rates go up, prices go down, and so you don't want the prices of your bonds to go down. So it's key to actually hedge out that interest rate risk. And the way we hedge out our interest rate risk is purely by shorting out the exact same duration government bond that we would as the corporate bond that we buy. So if we buy a 10-year corporate bond, we sell a 10-year government bond.
And explain what we're looking at here and how the long term of the curve is where you do not want to be.
Right. So this board is really a schematic of what could happen to your portfolio if you have a 10-year duration bond portfolio and interest rates, which are currently now in the 250, 275 range. If interest rates go back to their cyclical average, which is about 5.5 to 5.75 in 10 years, the capital in your long-only bond fund would drop by over 20% or by 20%. Can't really see this.
So to go back to understand, the difference between the credit risk and the interest rate risk, effectively, by stripping that out, it becomes a full credit risk bet, which involves the same kind of fundamental analysis that you might perform if you were an equity analyst in terms of understanding the creditworthiness of the people to whom you're lending the money. And how do you go through that calculus?
Yeah, absolutely right. It really does turn it into a pseudo-equity, but a low volatility equity. So remember, if a company goes into default, the equity is worth 0. If a company goes into default and you own the senior debt's probably worth 85 or 90 cents, depending on the situation. But that's why when we talked a little bit about leverage a little while ago, it's important to understand the leverage that's involved in some of your fund if you're going to invest in a credit hedge fund. We use low leverage on average 2 times. There are credit hedge funds out there that are leveraged 8, 10 times. And so what it does to the risk of your portfolio is it takes it away from interest rate risk, but it concentrates your risk in terms of within the performance of that company. So it is a little bit equity-like in terms of how the performance of that company works. And so in a credit fund, you're subject to systemic risk. And so, when 2008 happened, and you're in a credit hedge fund with no interest rate risk, your fund is going to be buffeted a little bit by that same item. So we have a board to show everybody what we do and how we handle that. We basically wrap the portfolio in systemic risk protection, if you like. And so this is something that we learned when we were at the banks. We developed this risk management methodology to make sure that their balance sheets were protected in bad markets. And I call this systemic risk protection. And effectively what we do is we stress test our portfolio about 200 times a day through all of the historical bad scenarios that we've all lived through. And most of us
we're looking at 4 of them here.
Yeah, so here's 4 scenarios of the historical scenarios. So if you look at the 2008 financial crisis, what we've got here is that the TSX dropped 39% during that crisis, whereas our portfolio, with its uncorrelated systemic risk protection hedges, would have, as of the end of June when this was run, would have lost 5%. So our goal is to run through 175, 200 stress tests every day to make sure that all the historical stress tests, our portfolio will take minimal losses in a systemic event. And then we've made up 150 or so stress tests that we don't think are likely scenarios, but we want to know that if those things happen, those bad things happen, what would happen to our portfolio?
Because the hypothetical scenarios are hypothetical, what level of certitude do you have when you do a stress test and say, if interest rates were to double in the next 60 days, what would our portfolio look like? How do you put those metrics together and say, we know that we would lose 3.5% or 4.8%, whatever the answer is?
Well, it's pretty easy just to do the math. So you have a portfolio, and when you run a stress test, what we do is the 2008 stress test, for example, we just basically run the prices of all of our assets from the day before Lehman Brothers went into default in September to the March 9th low of when the equity markets hit their low. And so every asset that we have in our portfolio, we run through those price changes. So it's a fact what happened through those historical numbers. In terms of the ones that we make up scenarios like interest rates at 0, equity markets down by 60%, and credit spreads widening by 250%. And we want to know what happens to our portfolio in that event. And so the primary way that we protect the portfolio, or the systemic risk protection that I talk about, is really by buying puts on the S&P, by buying calls on the volatility index, and by buying calls on the U.S. dollar.
Well, let's just touch one more thing on that, which is that during the financial crisis, it was really more than anything else a liquidity crisis. You mentioned earlier that the investment grade debt is the most liquid of all debt. But when you do the stress testing, are you certain that you would be able to stop losses and sell at specific prices?
Very good point. Very good point. When we do our stress testing, we assume that we're all idiots and we don't show up at work for that period and don't do anything. And so, we look at a stress test as being the worst case scenario. We actually think that through a stress test scenario, we'd actually add some value. We might actually be able to sell some securities and actually add some benefit to the fund as opposed to just sitting there like knuckleheads, hoping for the best. But yeah, it's a good point that we are in investment-grade securities. One of the reasons we're in investment-grade securities is when the proverbial hits the fan, we want to be in the most liquid assets so we can liquidate and get ourselves back to home.
All right, Mike, you also have a relative value strategy. Could you explain why you do that and how it works?
Well, a relative value strategy is a way of enhancing returns based on our credit research and our knowledge in the market. So it's a scenario where I would buy one investment grade bond and I would sell another investment grade bond. So in the market, it's called relative value or market neutral because it's not viewed as a directional bet. It's viewed as a play on one asset you think is undervalued, which you would buy, and one that you think is overvalued, which you would sell. And I think maybe the best way is for me to give you an example of one that we did last year so you can get a sense of what I'm talking about. So last year I bought 10 million 30-year Rogers bonds and I sold 18 million 10-year Shaw bonds. You might ask why different numbers. Different numbers because the 10-year bond isn't as sensitive to market moves as the 30-year bond is. So those are risk neutral in terms of the market, the broad market, that is. So I wanted to buy a 30-year bond because the life insurance companies and the pension plans were coming into their year-end reporting period. And at year-end reporting periods, companies like them like to dress up their balance sheets a bit, and they're going to want to reduce their asset and liability gap as much as they can. So their liabilities are all life insurance premiums and whatnot. And so we ended up, so we knew that they were going to extend duration on their bond portfolio. And at the same time, I wanted to own Rogers and be short Shaw, because Rogers had already done their financing and Shaw was acquiring CanWest, which I knew they were going to have to put more bonds in the market.
And it worked out well for you?
It worked out very well.
All right, very nice.
That's the moral of the story.
Thanks a lot for coming in, Mike.
I really appreciate it.
All right, thanks for your insight into fixed income. Good to see you, David. We'll see you next week. That's all the time we have today on alternative investing. Thanks a lot for joining us, and we'll see you next week.